Just a bit of background. Over the last 6 months, we've seen in the UK specifically both H2O and Woodford, a couple of funds which have offered daily liquidity. Woodford specifically had to sort of shut up, or put the gates up. And my prediction is that I think this is the tip of the iceberg, and it was a bit of a liquidity crisis. I think this is the tip of the iceberg, and I feel that managed funds and ETFs offering daily liquidity, which are liquifying the illiquid, I reckon there's going to be a lot more problems over the next, really big problems over the next 12 to 18 months. To demonstrate my problem, I thought I would use an ETF, the latest thematic high. It's the cannabis ETF. Now look, it's $1 billion fund. It's got a, it looks very liquid. It trades about 20 million Aussie dollars a day. It's sort of, some days it's done $200 million. By the look of this ETF, you can get in and out as much as you want on a daily basis. But let's look under the hood. Now, it's got its typical names like Canopy and Kronos, etc., but just under 15% of the fund are made up of these four companies. Now, this ETF is the largest shareholder in CanTrust, all these different names, at 13% of the fund. These are 200 to 300 million market cap companies. I'd argue that's not terribly liquid. I'll give you an example of CanTrust. It's had a pretty tough couple of months. In the last couple of months, it's had an investigation by OSC, which is the Canadian equivalent of ASIC. It's had Health Canada shut down one of its greenhouses due to non-compliance. KPMG's withdrawn its audit for 2018. Its CEO got fired with cause. Its founder got forced to resign. As you can see, the share price has sort of come under a little bit of pressure. But the good news is it's a bit of a cost out story. They've just fired 180 people. You might say that there's some potholes in the road. Sorry. Sorry. You can see the share price has fallen, but you can see CanTrust. It's actually gone. So the ETF has gone from 6% to 13% of the outstanding shares. I would argue owning 13% of a company with 250 million market cap, with all those issues, is not a liquid position. Now, I look at that ETF. Now, the share price of the ETFs come under a bit of pressure, but what I'd note is that the fund inflow has still been in fund inflow. If that were to turn to fund outflow of 20, 30, 50 million dollars, I can tell you the ETF manager will try and liquidate the positions the same, but it won't be able to sell any of this 13%. So the illiquid positions will become a bigger proportion of the funds under management. And so it will become a bit of a downward spiral. But I want to leave you with two things. I think you've got to be careful of funds and ETFs which liquefy illiquid assets. And the second thing I would make is liquidity dries up in a bear market. Thank you.